So first, it's right to focus on the dot plots. That is where the uncertainty is for this afternoon's Fed decision and what comes out in the press conference. It's not about whether they'll hike or not. They will hike. It's not whether they will welcome better domestic and international conditions. They will. It's what do they project about the path. I think what we're going to see over time, Alix, is a convergence again led by the Fed. So I expect market expectations to converge up to where the Fed is in 2018 and beyond. The only question in my mind is, does the Fed push that process now, or does it wait a little bit?
So what do they do? Because at the end of the day, you can make the argument that you have the Atlanta Now GDP is tracking 1.2% for the first quarter. If they upgraded their median dot forecast, they'd have to upgrade their GDP and inflation forecast. Do you really see them doing it at this meeting with the data that they have?
I suspect they will wait. And the reason why they will wait, they'll want to see what comes out of Congress and the administration. They want to see what happens to tax reform, what happens to fiscal infrastructure, what happens to deregulation, and what happens to trade. So I suspect they'll wait, but the only thing I would say to you is don't underestimate that this is a change in the way the Fed is targeting rates. It's going from being highly data dependent to being more strategic. It's going from following the markets to leading the markets, and it is hoping for the beautiful normalization of rates.
Okay, so
I would...
Mohamed, what changed? What was the trigger that changed them from that data dependent to the sort of holistic view of their rate path?
Greater confidence about the domestic economy, greater confidence that the international risks are coming down, possibility of finally getting fiscal structural reforms in place. So the context is changing. And I think the Fed has felt uncomfortable about being low for so long. So they're looking, in my view, they're looking for an opportunity to normalize, but normalize in a gradual fashion. This process of beautiful normalization is what they want. They don't want to stick around low for long if they don't have to.
Well, fair enough. One snag, though, could come from financial conditions. They've eased up quite a bit. Matthew Hornbach of Morgan Stanley was on with us earlier saying, look, if they hike and financial conditions don't tighten, that puts the threat of a stronger rate hike path on the table. What do you see?
I think that's right. I think that financial conditions have loosened as they have hiked, and that gives them the opportunity to hike. Remember, hiking has a few advantages. One, it gives them flexibility in future should the global economy hit a pothole. Two, it lowers the cost and risks or the collateral damage of artificially low rates. So yes, if it turns out that financial conditions remain too loose, they will hike further. I think the key issue is that this is a different Fed. This is a Fed that's going to lead the markets rather than follow the markets.
Is the market priced for that Fed?
Not as yet, but we've repriced enormously. A few weeks ago, the probability, implied probability in markets of a March hike was in the 30% range. And all it took was coordinated comments to raise it to above 90%. So no, the market isn't fully priced yet, but it's getting there.